Hey, what's up? This is me building a crypto personal brand in public until I hit $1 million in revenue. So how these videos normally go, there are three parts of them. First, I start off with a progress update. So this is just me sharing what am I actually doing today, like literally right now, in order to move towards this goal. After that, I'm going to be sharing my strategies and tactics that I'm using to move towards this goal. And then finally, I'm going to wrap up with a little bit of Q&A. All right, so let's get started with the progress update. So I'm on day number 4. Revenue is 0. Progress is 0. And I expect revenue to stay at 0 for quite a while because I'm just not ready to monetize just yet. So the monetization process has 4 parts to it: marketing, sales, delivery, and retention. So the marketing, first step, first phase, I have got sorted. I'm in a pretty good place with that. The next step is building out the sales process. So yeah, I'm still doing this. After the sales process is built, then is going to be time to build out the delivery process. And then only after this is built, I'm going to start actually making money. And then after that, finally, we've got the retention. And that is when I can start making a lot more money. But yeah, I'm currently on here on this phase, and I'm going to be on here for a little bit of a while. So yeah, I don't expect revenue to move up from 0 until I actually get this one done. Anyway, let's move on. So yesterday, Sunday, the Saturday and Sunday is usually when I write out and schedule all of my tweets for the next week. I like just doing all of my posts, like writing all of my posts in just one day, just crank it all out in one session when I get into a nice state of flow. And then yeah, I can easily just write everything out in one go. So I've got that done. Awesome. That leaves the next major task for this week, which is pushing on the mean reversion trading strategy guide. I've been putting a lot of time and effort in writing this and trying my best to make it an absolute banger. That's why it's still not ready yet. But as soon as it is ready, I will be posting it into my Telegram for free. Okay, so let's take a look at some growth stats. So this is the rolling 30 days of my X or Twitter account. About 1.6k followers in the last 30 days, so growth is going well. What's really interesting is this curve looks like a staircase. So I have like very slow, steady growth, and then suddenly I get like a big pop, like a bang. And then slow, steady growth, and then again, big pop, bang. And the reason for why I think this is because these time windows, they correlate with whenever I post something which is like really high effort, or when I'm about to tease or hype something, which is actually the topic that or the tactic that I'm gonna be talking about in a second. So basically, like throughout the week, I'll be posting like mediocre, like average-ish, like low effort posts, and then every now and then I'll post something really high effort, or I'll post like a promotion, like me trying to promote or hype something up that I will be releasing soon. Or I just post something that I have just recently released. And usually those posts do far better, far better than the average post. So that's where that comes from. All right, let's look at Telegram. Telegram was going really steady when I launched it, and then right now there's been a little bit of a drop-off. I think the reason for this drop-off is because I haven't actually made any posts recently where I go promote the Telegram and where I actively say something like, hey, go join my Telegram. So I'm not surprised there was a bit of a drop-off. As soon as my mean reversion guide is finished, I'm going to be promoting it quite heavily, and I'm going to need people to join the Telegram in order to go and get it. So I believe this will start popping up as soon as the guide is ready. And I also expect these numbers to start going up as well as I start hyping the mean reversion guide. All right, sweet. So that is the progress update done. Voila. And now we can move on to the tactic. Okay, so the tactic that I want to share today is the hype posting tactic. So let me explain. So if I'm about to post something really big and really important, what I would do is I would make several posts before I actually post the thing to just talk about, hey, I'm about to post this really cool thing. And these hype posts usually get roughly equal, or sometimes every now and then it will get even more engagement, more views, more likes, more comments, more followers than the actual post itself, which is like wild to me to think about. Crazy how like psychology works like that, but that's just at least from the data that I have. But anyway, my logic for this is how I approach X articles is if I'm about to post an X article, I will post twice about it before I go and post it to try and hype it up. Then I post the article, right? And there's a lot of like momentum from the hype before that, which is going into this article. And then after the fact that I've posted it, I will post again to talk about, hey, very recently, like yesterday or 2 days ago, I posted this really cool thing that I worked really hard on, right? So this is the approach that I'm using. Is this the best approach to hype? Maybe, maybe not. I don't know. This is just the way that I'm doing it. But here's my logic, or at least my theory. The more important or the more effort that you have put into a post, the more hype it deserves before going into the post, and also the more like hype it deserves after you've posted it. So you're like riding the tailwind, because it doesn't really make that much sense for you to post something very small, low effort and mediocre, and then hype it a whole bunch coming into it. That doesn't seem too ethical for me, because like people are going to be like really expecting something like super awesome. You get all this engagement from all this, and then you post something super disappointing. It's going to be a really big letdown to the audience, basically. And it's like, sure, you did farm all of this engagement, cool, but like you've let the audience down, and if you've let them down, it's going to be hard to do this again, right, in the future, because they're going to see you hyping something and they're going to say something, they're going to think, oh, here we go again, he's on his like exaggerated hype train. But like if you don't do any BS and you genuinely put in a lot of hype into something that you put a lot of effort into, and it was actually good, and the audience agrees that yes, this was in fact very good and worth the hype, the next time that you try to hype something, they're going to be even more excited, right? So don't abuse. This is my logic. You do whatever you want, right? But my logic is, I don't want to abuse this. I'm just using it relative to however big and important the post is. So yeah, quick summary: very big post deserves a lot of hype. Very low effort post deserves maybe a little bit less hype. But my formula for at least X articles, because it's just an article, like relax, is 2 posts before and then 1 post after. I don't think an article is worth more than this, and I also don't think an article is worth more hype after the fact either. So that's my take. That's my take on it. All right, let's go through some examples. So here I'm about to post this article, and I say I'm dropping a big fat article on this particular topic. So this is the hook to grab the attention of anyone who is scrolling. Then I've got the teaser. Here is what the article will include. Stay tuned, right? Look at the likes, look at the profile visits. It clearly works. Let's go through another one. I just hit a huge milestone. Thank you. Yeah, so these like celebration type of hooks, they happen to do well on X or Twitter, from what I have found. So as soon as I hit a milestone, I hit a new 1,000 follower milestone, I will just go and make a post about it, and those posts usually do well. And then after that, I will just slap on what am I working on? So I just say, yeah, I'm working on something very cool, stay tuned, right? So it's very vague, but it still happened to work, right? And I was honest about this. I don't recommend dishonesty. So don't say that you're cooking something behind the scenes when you're not actually doing something behind the scenes, right? So I would recommend to be honest about this. So yeah, 150 likes, 50 visits, clearly it's working. Next one, look, exactly the same format. Tomorrow I'm going to be dropping an article. This is what it's going to include. Stay tuned. Bunch of likes, bunch of profile visits. Again, same format. I'm dropping an article. I went pretty in depth with this one. Stay tuned. So this one didn't really include the teaser. Maybe that was a mistake on this one. So this one was supposed a little bit earlier last year. Maybe that's why I was still tinkering with the format. But like the idea is still the same. I try to grab the user's attention. I try to tell them what it's going to include, or how cool the thing is, and it will still get likes and profile visits. Next one, look, same format. I'm dropping an article. Here's the teaser. Here's what's going to be inside it. Bunch of likes, bunch of profile visits. Let's keep going. This is repetitive, but I want to show you that I'm systematizing this process. It's not just like I'm randomly typing. I'm formatting it in the same way based on what the data of my posts has been telling me. So basically, I like once a month, I would be looking back through my old posts that I've made. I'll look at top performers, and whatever was working on X or Twitter, I just do more of it because it is already working. Like if something has worked in the past and I do it again, it's very likely that it's going to work well again, right? So again, same format. I'm dropping an article. Here's what it's going to cover. Stay tuned for tomorrow. Bunch of bunch of engagement, and all of them are pretty much the same format. I do, however, really want to highlight this one because this is when I discovered that I can hype something more than one time before going into the release. So here I post the hype in a meme format. I receive your time and attention. You receive this article. It didn't like blow up or anything, but still it was like very low effort. This took like 1 minute, maybe 2 minutes of my time to go and make this. But it still got 100 likes, 26 visits, and I paired this with this one, right? So I got an extra, like, what is that? 180 plus another 100, so that's 280. And then with the visits, I got 92 plus 26. Oh, scrolled too much. 26, so that is 118, right? So I got a bunch of extra engagement going into this article. But yeah, the lesson that I got from doing this is that, I can hype an article 2 times before I actually post it, and then I can even hype it again after the fact that I've posted it. And this way I get to basically crank up how much leverage do I have on the engagement of the original post, right? All right, I hope that makes sense. Before I move on, I'll just like quickly summarize. If you're posting something very high effort, it deserves, rightfully so, it deserves a lot of hype before you actually go and post it, right? If you actually care about your followers, it is within their best, it is within your best interest to help inform them that you're actually going to be posting a banger, right? So don't feel guilty or shameful about hyping something. Like, yeah, I know there's a lot of like bad actors who just turbo hype and deceptively hype, but like if you're actually going to be posting something good, it deserves the recognition and it deserves the eyeballs. If you're going to be posting something mediocre or low effort, like an article, you probably don't need to be hyping it like to an absolute insane degree. If you're going to be posting a very lengthy video, maybe like a 1 hour or 2 hour, or even more than that, like a really lengthy, really lengthy, in-depth video on X, then sure, by all means, go hype it more. All right, so that's the tactic of the day. Done. Now let's get through some Q&A. We have a bunch of questions today, so yeah, let's get through them. Okay, so first question is from Galen Georgioff. How to code consistently increasing volume when there is nothing consistent in the marketplace? This is an interesting question. I'll just translate this question into how are we supposed to measure if the volume of a coin is increasing, decreasing, or flat? So the way that I do it is like this. It will require a little bit of discretion, but just bear with me. So imagine if we have sideways price action like this, and then all of a sudden it starts staircasing. Right? So this would be one market regime. This would be another market regime, right? Now, let's say the volume throughout all of this time looks something like this, right? And then we were to plot the average volume throughout this entire window of time. What I would do, like let's say this is where price is now. So this is where price is now. Last traded price is right here. In order for me to tell if the volume is increasing, decreasing, or flat, this is what I do. I look at what is the average volume right now. So it's up here. What is the average volume at the starting point of the regime? So the starting point of this staircase would be right here. Was the volume increasing, decreasing, or flat? As in, is this point, is it higher than the starting point? Is it lower than the starting point? Or is it roughly the same? So it's significantly higher, therefore volume is increasing. Okay, just another example. Imagine that before this choppy range, we had something like this, right? A downward staircase. And also during this downward staircase, the volume looked something like that. Yeah, I'll do something like that, right? So where is this starting point? And let's pretend that this price action on the right-hand side hasn't happened yet. So I'd say, okay, where is the volume now? It's down here. Where is the volume at the starting point of the regime? It's here. Is it increasing, decreasing, or flat? It's flat. So that's how I would do it. That's my approach. All right, let's delete all of these lines. Maybe I just need to select. Yeah, I'm just gonna try selecting. Hopefully that doesn't break anything. Okay, sweet. Sweet. All right. Next question. Shahir BTC, he asked, bro, what trading journal are you using? Any suggestion? Yes, I do have some suggestions. So right now I'm using my own custom trading journal, and in the near future, I will be releasing one that is more, like it makes more sense for the average person to use. This will be coming very soon after my mean reversion guide is going to be finished. So that one is coming very soon. If you don't want to wait for that, I do have two extra recommendations for automated journals that you can use. So you can use CoinMarketMan or you can use TradeStream. So I'm not affiliated with either of these. These are just two journals that I have. Oh, there's one more actually. There's one more that I know of. There's also Edgewonk. There we go. So yeah, I'm not affiliated with any of these three journal companies, but basically they are automated journals where you connect your trading account on the exchange with an API key to the journal, and then all of your order history just gets processed into the software, and then you can basically look at all of the trades that you've taken without actually manually inputting any of the data yourself. So yeah, if you want to use an automated journal, you're welcome to check these out. I think they might have some free options or paid options, or they might have like some free option where, yes, it's free, but you have to do a certain amount of volume on an exchange in order to access it. I don't know what kind of deals they have, but yeah, go check them out. Go see if they have any free trials or something like that, and then make your decision. But yeah, if you're not into the automated journals, you can just wait for me to release my custom one. All right, sweet. Let's move on to the next question. So this question came from a DM, so hence I want to make the name anonymous. So his question is basically, okay, let me just read it. Hey man, I wanted to ask you, I wanted to ask something you probably see a lot on timelines, but as someone not as experienced as you, I'd like an answer. Regarding the cryptocurrency market, I sometimes think it's a huge bubble of crime where people only get ahead by deceiving others. Whether it's with fraudulent tokens or signal rooms where you trade an asset that doesn't even exist on TradingView. Given this, is it better to trade on cryptocurrencies or Forex or stocks? Okay, let me cover this first question before covering this next one. Okay, so the first thing, the elephant in the room is, yes, there is an outrageous amount of crime and bad actors in the crypto space, running pump and dump groups, doing running shady ICOs. Like not even that long ago, I think like a month ago, there was like a huge like 10 million like very sketchy case with an ICO. So yeah, there's a whole bunch of like very, very bad shenanigans that are happening in this space. But I don't actually think that this is like it's not something that makes trading hard, or it doesn't like interfere with trading. Like if we just look at what actually is trading, all we're doing is we're trying to find an edge, which is an advantage where we believe we have some kind of statistical advantage. And then we go and execute on that edge until the edge decays or until the edge fades away. And then as soon as the edge fades away, we then have to go and find a new edge. So for example, this is just like me spitballing here, but like you can go and look at the historical price action of Bitcoin. And then you test a whole bunch of patterns on Bitcoin. Some of them suck, some of them are okay, and then you happen to find a particular pattern which looks really interesting. And that pattern may have appeared like 600 times in the past 3 years or something like that. And out of those 600 times, if you were to buy Bitcoin whenever this pattern happened to appear, 59% of the time, oh, there we go, 59% of the time, the price would go up by 1%. And then 41% of the time, the price would go down by minus 1%. So if you were to just take advantage of the fact that you have access to these statistics while the average market participant does not have these stats, you can go and take trades like this and make money off this edge until the edge shrinks. Like the 59 might drop to 58, 57, 56, 55, and this 41 might. So basically the gap between here over time, it will start to shrink. Right? And then when it gets small enough, you can abandon the idea, you can abandon the edge, and then move on to going and finding another one. That's basically what trading is, right? So just the fact that, yeah, there's a whole bunch of bad actors in the space, it has nothing, it doesn't really have that much to do with the inability to go and discover edge. So that's point number one. Point number two, this is a really interesting one. Why are there so many bad actors in the space? Like, what, and why are there still so many bad actors in the space? It's because the players in the space. Now, I'm gonna say something, but I'm gonna say something maybe questionable, but please bear with me. This is just me sharing my true and honest opinion. The players in the crypto space, like the average players in the crypto space, they are not that sophisticated, right? They're not the sharpest knife in the drawer, right? They're not the brightest light bulb in the room, right? The reason why there is so much predatory behavior in the crypto space is because the players keep getting deceived. They're just not that intelligent. And because crypto players, or like the average player in the crypto space, is not that skilled, it simultaneously means that the competition that we are up against as traders is also not that sophisticated, right? So if I like using the poker analogy to explain this point. Imagine that you are at a specific level of skill at poker where you're good enough at the game where you can go and make money professionally, right, from playing poker. And imagine you had two choices, where the first choice is you can go and play on a Saturday night at the casino, or you can play on a Tuesday morning at the casino, at the same casino, right? If you were to go play poker on a Saturday night, the likelihood that you get matched against some drunk opponent is significantly higher, right? You're not guaranteed, but it's significantly higher, right? So you're going to be matched against players who are, on average, less skilled, maybe under the influence of alcohol, and you can just make money simply from them making a lot of errors. So it's not even about you being super duper skilled. It's more about them just making a lot of errors. And if we think about what even is an edge, it's an inefficiency that often will exist because other market participants are making mistakes, right? Whereas if you played poker on a Tuesday morning, you're matched against a bunch of professionals. They're not going to be making as many mistakes, so there's less edge to capture, right? So that's the point that I'm trying to make. The fact is that the average crypto player, I'll sum this up, the average crypto player is not smart. They make mistakes, and as soon as other people make mistakes, we as traders can be there to capitalize on those mistakes, right? Okay. Next question is, what's happening in the crypto market normal? I've only been here since 2023, so I haven't had that much experience. So for context, crypto since the year started has not been looking that good. And also for the past 12 months, it's just been doing this, right? Yeah, totally normal. Totally normal. If you want to experience plus 100% gains on an asset, you're gonna have to at least prepare yourself mentally for minus 80% drawdowns. There have been plenty of instances where crypto has dropped 80%, 50%, 60%, those big double-digit numbers. So if it's done that plenty of times in the past, we shouldn't really be that surprised for it to happen again. And at the same time, crypto has been on massive runners doing 100% moves, 200% moves. I'm talking strictly BTC, right? It has done pretty wild moves before in the past, plenty of times. So again, using the same logic, we shouldn't be that surprised for it to run upwards very heavily as well. So if we just zoom out a little bit, we should be comfortable with an 80% drawdown, and we also shouldn't be dancing outside celebrating if we have a plus 100% gain as well. This is just very normal, right? It is to be expected. It's crypto, it's the Wild West. The thing moves as fast as a roller coaster, both up and down. So yeah, totally to be expected. All right, next question. So I'll try to sum up this question because there's a conversation thread before this question. But basically what this guy's asking, I kept him anonymous because it is from DMs. He's asking, I'm thinking about using multiple take profit targets instead of one. What do you think about that? I spoke about this a couple of videos before, but I'll say it again here. And that is that if you are adding complexity to your trade execution, so you're not exiting the trade in one order, but you're exiting out in 3 different orders, you are reducing the variance of your P&L. You're getting a more averaged out exit price. And if you do the same for your entry, you're going to be getting an averaged entry price, which is nice because it improves, like it reduces the variance of like how jumpy your P&L per one trade can be. So that is nice. But the issue is that your learnings or optimization speed is also going to go down with it, right? Because if you add more and more and more variables to how you enter and exit trades, you're increasing like the amount of time that it will take you to go and optimize optimize those variables. So this is what I mean, right? This is what I mean. So let's play this out, right? Let's play this out. So you have three points where you're looking to exit, right? And then you go and take 100 trades, right? Let's say, you know what? Let's say 300 trades. And with these 300 trades, let's say 150 of them were winning trades, right? And then later on in the future, you say, I wonder if there's any way to go and optimize for my take profit targets. As in, if I made my targets slightly tighter, would I actually make more money? If I made them slightly wider, would I make more money? If the position sizing between these three orders was not equal, but actually if it was like scaling out, like gradually like this, would I make more money? Or should it be inverse, where I get out most of the position, like 70% of the position on TP1, 20% of the position on TP2, and then 10% of the position on TP3. Which combination is like the most robust or the most reliable to give me A, more profit, and 2, less P&L? Right? So we have like so many different combinations to go and test. And to go and test all of them, it's not going to take you 3 times the amount of time. It's going to take you 9 times the amount of time, because it doesn't, like, complexity with every time you add one extra variable, it doesn't actually scale linearly. It actually increases exponentially. It's because if you have, look, I'll show you what I mean. If you only have one variable, you only have one thing to test. If you have 2 variables, so like A and B, we have AA, AB, BA, and BB. So we have like 4 different combinations. If we have 3 different variables, it's gonna be 9, right? So your complexity curve basically exponentially scales, which means that your learning speed is basically the opposite of that, right? So it's like the logarithmic. It's going to be a log curve, where the less complex your system is, the easier it will be to learn, and the much faster speed of learning, and the faster that you can actually optimize your strategy. The more complex your strategy is, it's going to be so much more challenging to go and optimize it. I actually think I drew it wrong. But yeah. The point is that the harder your strategy is, the slower your learning speed will be. The more simple your strategy is, the faster your learning speed will be. So here's how I would approach it. If you have not yet done any optimization to a strategy, and you are just in the process of building it out, or you're still like kind of tinkering with things, keep it as simple as humanly possible, because that will allow you for the fastest learning speed. Right? If you build something first time round, it probably will not be the best possible version of whatever that thing is. It's only going to get good after you improve it. Therefore, the goal isn't to build something amazing on the first time round. That's not the goal. The goal is to build something so that you can have, the goal is to have the fastest improvement speed possible. It's not to build a banger or like to build something legendary on the first shot. It's to build something that's super easy to improve so that it can become a banger and become something legendary in the shortest window of time possible, right? So yeah, I would recommend just stick to one target. Keep things as simple as possible. The data that you're going to collect is going to be as super easy to interpret, because there's only one TP. Like, to optimize one TP, you just have to ask, if this target is tighter, will I make more money? Or if this target is wider, will I make more money? That's it. There's only 2 questions that you're asking, not 9 different questions that you're asking if you have 3 TPs. And don't even get me started on like how you're going to be spreading the position sizes between 3 TPs. Like, is it evenly spread? Is it like increasing over time? Is it decreasing over time? Do I have to spread the orders out relative to what's like in the order book, right? It's going to be a nightmare. So yeah, just keep it simple, and that way you're going to learn at the fastest speed. All right, next question. I'll I'll skip to what this question is basically saying. The point of this question is basically, how do you manage your spot bags, or how do you manage your spot positions with Bitcoin? So I have a super simple approach, right? So I treat trading and investing in like 2 completely different extreme categories. So trading is a very active form of making money, whereas investing is a very passive form of making money. With investing, this is how I approach it. Once a month, I go shove some money into Bitcoin, and then I do a bit of a rebalance. That's it. So my minimum exposure to Bitcoin relative to my net worth is 10%. My maximum exposure is 30. That means that, let's say my net worth is 10K, let's just pretend, and then I have 3.1K in BTC. As soon as I exceed this 3.1, like this 3K threshold, this extra leftover, the 100, I will just go sell it back into cash, and now I'm sitting at the maximum exposure, right? So whenever I go beyond my exposure, I start selling. That's it, right? That's literally it. I keep it super simple, right? Sometimes just with my pure gut and pure intuition, sometimes when I'm a little bit overexposed, sometimes near the 30s, I will be selling a little bit more dramatically so that I can drop down to about 20-ish% exposure. Like if for whatever reason I think something is going to run just a little bit extra, okay, or like if I think that it's already like something has already run like so much, then okay, fine, I'll be a little bit more ambitious with how I'm moving to cash. And the same goes for the opposite approach. So let's say BTC is dumping a whole lot and my exposure drops below 10%. Cool, that just means I'm going to be aggressively buying, right? And my time horizon for this, for me just being exposed to spot Bitcoin, it's like 5 to 10 years. So like I literally couldn't care less how the price action looks like during this time because I have such a huge time horizon, right? The idea here is I think that governments are going to keep printing money. Therefore, I think the value of cash is going to be going down over time. And if I think that the value of cash is going to be going down over time, then naturally the value of stuff which is not cash is going to be going up over time relative to cash. So relative to cash or fiat, right? So me just holding some Bitcoin is just me. This is like a synthetic short on the US dollar. That's basically why I hold BTC. I'm like short US dollars. That's it. That's literally it. So, yeah, what this means is that every time that I'm buying or rebalancing to get more exposure, I could be buying at the most random and weirdest of places. And the same with me selling. I'm probably not going to be selling at like the perfect highs or like even near the top. I just sell whenever my exposure gets a little bit too high. But because I'm buying whenever I have low exposure and selling when I have high exposure, I still manage to capture this gap and I'm still technically making money and it still technically works. I'm not making a bajillion dollars every year, but I'm making something, and that's the whole point. It's investing, right? That's the point. Now with trading, it's a completely different story. This is very active, where for two or 3 hours, I sit down and I'm very, like, the timing matters. The entry matters. Where price is sitting on the chart actually matters. My exit matters. And my average trade duration, like once I jump into a trade, it's about 1 hour, right? So compare 1 hour to like 10 years, right? It's a very big difference there. So this is when I actually try to get a good entry and a good exit, and they matter to me, and how the chart looks like also matters to me. Whereas anything to do with like my spot bags, I couldn't really care less how the chart looks like. It's just I'm taking a bet that I think the price of Bitcoin will be higher in 10 years from now, and the way that I'm expressing this bet is just by doing this rebalancing strategy. That's literally it. So okay, question 6. So I wanted to give some context to this question. So I made this tweet, And here's what I say. I say, using a trading journal instantly puts you into the top 20% of traders. If you go and actually open the trade screenshots and review your trading journal, you get put into the top 2% of traders. And then if you actually use your review that you just did to come up with more ideas to improve, you're going to be in the top 1% of traders. And then Foist last, he said, is there any source for these figures? I would be interested in any studies or surveys, but I can't find any so far. Please, I want to know the source for this data that you pulled. Foist, I'm sorry, I had to do it. I had to do it. So look, these numbers I am pulling out of thin air. Whenever you see data being posted on Twitter, don't take it for absolute fact. I'm just conveniently putting these numbers here, but I'm making a point, right? Here is the point that I'm making. The point is that barely any crypto participants, or just traders in general, or just people in general, actually track the thing that they want to go and get better at, right? So like, if you want to get better at tennis, you should probably record your game footage. If you want to get better at chess, you should probably record every move that you are making, or when you're playing on the chess platforms, have like a record of like your mistakes or your wins or your losses, right? If you're doing anything, like, I don't know, playing guitar, again, you're trying to get better at guitar, you should probably record yourself playing guitar, right? The point is that barely anyone who actually is trying to get better at something goes and measures the thing that they're trying to improve on. So if you just, the act of measuring it already gives you a very big advantage, right? So that's the first thing. Then the next point is that there's a whole bunch of people who are tracking the things that they're trying to get better at. But if you're tracking and you're never actually looking at the thing, this is like buying a book, but then never actually opening it and reading it, right? So very few people actually go and read their own journal or read the book that they've just bought, right? So this again is the next advantage. And then finally, very few people actually go and change their behavior after doing this review. So the book analogy is, very few people actually go and journal their stuff. Very few people actually read the journal. And very few people actually change their behavior after reading the journal and after learning the insights that they need. Right? So the point is that please use a journal. Please actually review the journal. And then finally, please actually go and change your behavior after you learn something from the journal. All right, next question, and this will be the last question of today. So Matthew asked, why did you choose trading as your x-axis? So let me give some context. In the first video that I made, I presented this graphic. So we have the x-axis and the y-axis. The y-axis is your monetization potential. So this is like how good you are at business. And the x-axis is how good you are at a technical skill. So in this case, it can be trading, it can be chess, it can be tennis. So for example, if I'm really good at tennis, the better that I am at tennis, the more money that I can make from the game of tennis. If I happen to mix the skill of marketing with tennis, my earning power can potentially go up, because let's say I'm a really popular tennis player. I'm really good at tennis, but I'm also a popular tennis player with a brand. And by having that brand, I promote Nike or Adidas or tennis racket brands, etc. And how much money I can make as a player goes up because of my sponsorships and the promotions that I'm doing. But if I was to take it an even step further, and I not only have the skill of marketing, but I also have the skill of sales and product or service, and I go and build my own tennis product. Let's say I go and build my own tennis club, or I start a tennis coaching education thing, or I build my own tennis racket, or I create my own tennis clothing brand, right? Then my earning power will go up even more. Right? So your earning power is your monetization skill multiplied by how good you are at a technical skill. If you're really good at monetization, but you suck at the technical, sure, you might be all the way up here, but this is all that you'll get, right? If you're really good at a technical skill, but you suck with the monetization skill, then you'll be limited here, right? So it depends, right? Let me draw this out so it can, yeah. So like if you could be like really, really good at the game of tennis, but you just suck at monetization. There could be someone else who's like really, really good at monetization, but they have less skill. So there is a bit of a delta or a gap that can occur. But okay, the question is, why trading? Why trading? So let me give some context. So before I was trading, I was running a gambling business on a video game called RuneScape. And in this business, this is how it worked. I would there was basically a virtual casino inside the game. And how the casino worked is there would be a whole bunch of people who are sitting inside an arena, and they're all saying how much they're willing to wager for a death match. So when you challenge someone to a death match, the way that the game works inside that specific death match is that there is a 50-50 chance of winning. So it doesn't matter how good you are at the game. It doesn't matter it doesn't matter what you do. The chance of winning will always be a fixed 50-50, right? You versus someone else, 50-50. So it's very popular for people to come in to this virtual casino and start betting their money just for the sake of gambling. So people will go and bet like $100 for $100. But here's the issue. In order to go and make this bet, you would have to go and sit there and actively type betting $100, betting $100, betting $100 until someone else who also wanted to bet $100 would move their character up to you and then go and accept your challenge, right? To go and bet $100. So then you both would put up $100, you'd accept the bet, and then you'd go into the death match, and then it's basically a coin flip to see who would win. But as the size of the bet goes up, the waiting time to find a challenger also goes up. So for someone who's willing to bet only like $5, it doesn't take that much time to also go and find a challenger who is willing to also put up $5. But if someone wants to bet like $1,000, right? If someone wants to bet $1,000, they might need to wait like up to 10 minutes before they find someone who's also willing to put up $1,000. So this is where I come in. So I would have an account in the virtual casino who would be willing to, and I would be willing to accept any size bet, range from like $1 up to $5,000. And I would just accept all bets that came my way, but there was a catch. The catch is that whatever the size of the bet that they put up, I will be putting up 10% less. So if they put up 100, I'm only going to be putting up 90. So they're basically paying me this 10% fee to get their bet called without waiting. So it's like a waiting fee. So basically what I was doing was market making people who really wanted to bet and to gamble. And I was being paid a fee for or a premium to just reduce their waiting time. That's basically what I was doing. So I would be getting somewhere between like 50 to 200 bets per day. Some of them were ranged like the smaller ends were like $3 each, and some of the higher ones, like I wouldn't really go beyond this, but every now and then someone would come along and start slinging like multiple thousands consecutively over and over again. So that was what my job was before trading. Now, during that time, especially, this was like towards the end of 2016, what I was doing was I had to offload this virtual currency into real money. So I had to sell this virtual currency to other people on the marketplace for PayPal. Now, what happened was PayPal eventually froze my account. And I needed to find a different payment processor because how was I supposed to pay rent? I needed to get this money into fiat somehow. So I discovered this thing called Bitcoin, and I would move the RuneScape currency into Bitcoin, and then I would sell the Bitcoin for fiat, and then problem solved. So I wasn't using Bitcoin because I was super bullish on the tech or anything like that. It's just that, oh, cool, there's an alternative to PayPal that I can use to actually go and pay my rent. Awesome. So that's how I discovered Bitcoin. Now, when 2017 came around, there was a giant bull run, and it was so insane that whatever money that I had in Bitcoin at the time, which was just, it wasn't even an investment, it was just there for logistical reasons whenever I needed to top up on more virtual currency or offload it, or like I was still in the process of selling it for fiat. Whatever I was holding, I was making more money just from simply doing nothing compared to working 12 hours a day for 7 days a week. So I got really curious with what this Bitcoin thing was, and it made me think like, if I could make so much money from literally doing nothing, I wonder how much money I could make if I was to do something, like if I was to actually try rather than do literally nothing. So hence I discovered trading, and I found that trading is actually very similar to this business model in the sense that I have to go and take a risk. There is a chance of winning or losing, and then there is a reward. And then at the end of that, there's going to be some EV. And then when I looked at like a lot of trading education videos, even the traders were using the term EV. And that was really refreshing, because it's like, oh, there's actually a lot of overlap with the casino/gambling business and trading. And that's when I realized, oh, okay, so there's a lot of similarity here, so I could actually try to pursue this. And at the time, the business, like the RuneScape business, started getting worse and worse and worse. Players were like less incentivized to go and gamble. They eventually got rid of the virtual casino. So yeah, basically the RuneScape business died. And I had to make some kind of pivot. I had no prior skills to doing literally anything. So I'm thinking, okay, I have to make money somehow. So I'm going to get into this trading thing. So yeah, that is how it all started. All right. That was a lot of questions for today. On the last episode, I only got one question. But yeah, guys, if you have questions, please don't hesitate to DM me on Twitter or X. Don't hesitate to leave a comment below, and I will literally answer every single question that I get, because one, it helps with my engagement, and then two, it also helps you because I'm providing you value, and three, it also helps other people who might also want to know the answer to some of these questions. So guys, thanks again for tuning in to today's episode, and I will see you guys tomorrow. Thank you.